Hello and welcome to Options Guide TV. My name is Brian Overby and I am the author of the Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. Today's date is Wednesday, July 31st, the last trading day of the month. The Fed is about to speak. They're not supposed to say much except for the fact that everybody's going to be leaning on every word that they say in regards to the September Fed meeting, where right now the Fed futures are showing 100% probability of a rate cut and a 70% probability of a rate cut in November, on top of the one in September. So far, that has been positive to the markets. So the old adage of bad news is good news as far as economy slowing down, unemployment numbers staying, holding steady. A lot of people have used the term Goldilocks economy as far as the Fed is concerned. So it looks like we'll be cutting rates. Well, at least the Fed futures market thinks there's a 100% chance that we're going to be at least a 25 basis point cut in September. The VIX is still remaining high. We have it trading right around 16, high relative, I guess, to about a couple of months ago. And so it's odd to see such a strong marketplace and see the VIX actually react to new highs in the marketplace. Now, there's been a rotation, and we've done a lot of trades recently in the Russell 2000 index, or IWM, the ETF that tracks the Russell 2000 index. So a couple of things that the one trade that we did, well, we've done this a few times on Options Guide TV, is a long straddle. I enjoy doing it in the Russell at a precipice on the charts. If the chart is telling me that there's a possibility of a big move in either direction, I always feel like the Russell underestimates the volatility of that index in general. So I don't mind buying long straddles, buy the at the money call, buy the at the money put. Now, since we are talking about the rotation and volatility is still high, I flipped it around. And instead of buying a long straddle, because we got the VIX trading north of 16, and just a moment ago, it was above 17, right? So now I want to sell some premium in the Russell 2000 index. And we did that in two stages. We went out on Friday and we sold a out of the money put position. And then we came back on Monday and we sold an out of the money call position. Ideally, what that did was we rolled in, or we legged into an iron condor. We did it by doing the two spreads. You combine a short put spread with a short call spread, and voila, you have an iron condor. So that trade, if I look at it, I'm just going to pull that up. First of all, we're also going to look at Meta today. So let's run to Tradier Pro software and we'll pull up the IWM. The IWM right now is at 224. It's bounced back from Monday. So, we don't pick when we do Options Guide TV, but I always want to come up with a trade. So, and I'm always trying to trade and adjust positions during the show. So with that said, we did that adjustment on Monday, and the market's still doing pretty well. We put the short put spread on with the market around 222, and right now on Monday the market was still right around that range. And now here we are on Wednesday, the last trading day of the month, and we see that the market's at 224. So our condor is doing all right. We went out to the August 9th, which is the Friday expiration. You have a plethora of expirations to choose from in IWM. And I think we're just going to continue to let it ride. But I thought I should set it up just so that we can take a quick peek at it. On the August 9th expiration, we have sold the 206 put option. So the 206 put option with the August 9th expiration is trading for next to nothing. We sold the 206. Oh, no, that's the one we bought. I'm sorry. That makes more sense to me. Let me get rid of that. And this is the one that we bought, is the 211. and then we sold the 20. We sold the 211 and we bought the 206. Okay, so here we go. Let's try this one last time. Third time's a charm. Okay, so that's 22 cents at this point in time. When we put it on, we were trading close to 50 cents when we initially put on the trade. So we're up about 20 cents. We're up half of the premium is the way that I like to look at it on what we received on that. So time decay is working for us. Now we've had the market bounce back. So this one will be going against us a little bit, but still within the range, right? It's still not making that big move in either direction. So on the call side of things, we sold the 232 and bought the 235. All right, so let's get this one right the first time. Sold this one and then bought that one. All right, so now that one's gone against us about a quarter. So overall, we're pretty much flat on the position. We put this trade together. Oh, no, that actually let me get rid of this. Let's put this one on. Okay, so right now it's at a credit of 76 cents, and this is trading for 53 cents. Great. We put it on for 42 cents. We're down a dime on the call side of things. We're up a quarter on the put side of things. Trade's doing well. Let's hope. We still have a slew of earnings. We still have the meeting. Now, if we can get it for about 25 cents, I could see taking the whole position off. One thing that we might want to do if we're going into the weekend and we still show a little bit of strength is close out the put side, or you could even roll it up. And here's the concept, and this is the way I like to adjust some of these trades. If it's going against my call side, I want to protect it by selling a closer to where the underlying stock is short put spread. I'm going to bring in a decent credit, but I don't mind being closer to the stock by rolling up. We have a profit on it by rolling up because we have a shorter time frame. We're going to stay in that same days to expiration. So now we only have 9 days remaining to expiration, and we had 14 days when we first put on that trade. So if we make it, we still stay within this range, a little volatility right around that 222 area and kind of hang out there. Well, maybe to try to protect our call spread, we'll actually bring in a larger credit on the put side of things. And I don't mind doing that. That's one way I like to adjust iron condors. Now, if the call side, if it goes strong and it gets to our short strike, well, then I want to do something on the call side of things. I don't want that that 3 points of risk to come into play, if you will. This is where my magical number is, right at the short strike. I definitely don't want it to go beyond my long strike, which is the 235 strike call option. So this is the way, well, we got rid of the put side of things, but this is the one that's at risk, the short call spread. And I wish we would have waited and did it on Tuesday, but we got the show on Monday. So that's neither here nor there. Okay. Now, Microsoft, we looked at a long call spread in Microsoft, trying to get bullish on it. But, the market just in general is not liking mega cap tech stocks. So we had a sell-off, broke through. I mean, this chart looks horrible. It's been a strong chart since the beginning of the year. You're a little bit nervous if you get down to this area, right at the 400 level. There's a lot of support in Microsoft, but right now it looks like you're just catching a falling knife. But we managed our trade by doing a just out of the money long call spread. It's not even worth looking at because it's trading for zero at this point in time. It goes out until the Friday expiration. We put it on for $1 and now it's worth nothing. That simple. But we managed our risk by doing the short or the long call spread by buying a call and selling a call against it. Now we have Meta, and Meta is interesting in that it's really made a strong move today. It's up $10 today. On a percentage basis, that's not a huge amount. Let's put Meta in the chart here. Right now, it's about 2%, but it's still a very solid move heading into earnings after the close today. So I guess I would ask you, I'm a little befuddled which way I'd want to go. I probably wouldn't trade it with my speculation money. I liked the Microsoft trade better, and that one, was just dead wrong. It was buy the rumor, sell the news. Basically, they're the numbers that the expectations that the marketplace had were outrageous for Microsoft. It was a very high hurdle for them to leap over, and they just couldn't quite get over that hurdle. But they had a really good, a real good quarter, honestly. So kind of more buy the rumors, sell the news. Had a good quarter. The expectations were just too high, and the marketplace took it as an opportunity to take some gains. Still like Microsoft. If anything, I think it's a buying opportunity. Maybe you sell a put to try to buy some more if you'd like to participate. They're coming out with a new search tool within Chat GPT to try to battle with Google. Google has been strong. It's one of the Magnificent Seven that actually has kind of held its own weight. But today it's Meta. I want to look at, let's flip the script. We're up 2% on the underlying stock. The NASDAQ is up a little bit strong. Let's buy a put spread. We did a call spread, so let's buy the put spread. I'm a little nervous, as you can see, to say that, but let's look at it. August 2nd, 2 full days away. Amazon's announcing tomorrow after the close. Meta is announcing today after the close. So I'm going to do the same scenario. We're going to buy a just in the money. We're going to buy a just out of the money put in Meta. So we're going to go, once again, we want to know what the expected move is. So let's start with that. So let's buy this expected move. We're going to buy the 272. We're going to buy the 272, and we're on the put side, and then we're going to buy the 272.50 on the call side, and that's a 40-point move. So we take 40 divided by 473. 40 divided by 473, we come up with about 8%. So we're looking at a real move in the underlying, but more importantly, I think the number that I want to focus on is 40 points. And I do see we got a question. I will address that as soon as I finish the trade here. 40 points from here goes all the way down to 430. We're going to go somewhere right in the middle. We want to make sure that the marketplace, if the news is bad, or it's the same situation in Microsoft where we're gonna sell, buy the rumor, sell the news, take it as an opportunity to sell off on Meta. Meta's had a real strong outlook just over the last couple of months, just like a lot of the mega cap tech stocks. And we're going to buy the 460, and then we're going to sell the 455. So let's look at that. Boom. And 455 sell. And we need to get rid of these two. The long straddle, which gives us the expected move. Okay, so in this instance, we're going to be risking $2 to try to make $5. So on our upside, we'll just make it 2. 197 is the mid. Let's make it 2. The math is real simple. And this will be our official paper trade in Meta going into their earnings report tonight. We're staying within the expected move. We're going to be bearish on the underlying stock, but we want to make sure the marketplace, if we are correct in our forecast, we need the stock to get to 455. And so we want to make that feasible. We want to make that part of the feasible move. And a feasible move to me is the expected move. The price of the at the money long straddle, the price of buying the at the money long call, and buying the at the money long put. Okay, so that's going to be our official paper trade. And let's go ahead and put the question up today. Anthony. Hello. Wow, Anthony. I haven't heard your name in there in a long time. But thanks for coming back. What would you set up in Meta if you wanted to go short-term short? All right. Well, I think I just answered that question. I must have been channeling you while we're looking at Meta. All right. Now, you can choose the amount of upside and downside. Here's my whole thing. If I'm doing short-term bearish in Meta, and I'm doing it on a speculative basis, I can decide how much risk I want to do. I just want to make sure I'm within that expected move. So if I want to, and I want to be a little bit more bearish, I could actually sell the 450s, do it 10 points wide. I'm going to end up putting up $3 or $4 somewhere in the middle. We can go that way. So let's get rid of this and we'll sell this one. Yeah, 375. So now I'm risking 375 to make 10 or 4.25. Put a little bit more risk in, but I'm still within the one standard deviation move, right? Or I'm sorry, the expected move of the marketplace within that one straddle move, which is 40 points to the downside. So if we do get some downside and it does align with our expected move or what the marketplace is saying, it's saying that we could hit the maximum on our trade. So you decide the risk. Whenever I'm on Options Guy TV and we're looking at a speculative trade, I always try to keep the risk around $100 or so. You can choose to do a 10 lot or a 15 lot, but I always just look at a 1 lot trade. And what's more important to me is to just say, if I'm going to lean this direction, this is the strategy from the options playbook that I would like to use and how I would like to set it up. When I'm looking at long call spreads, I'm 100% thinking about how much time value I'm buying versus how much time value I'm selling. If it's around earnings, I'd rather do a long call spread or even a butterfly trade. Like on Amazon, I might go and do the other direction and we'll look at a skip strike butterfly on the upside, which is an alternative to a short spread, selling some of the volatility premium on that side. So let's see where we're at with time. Yeah, we got a few minutes here. Any other questions? Any follow-up on that, Anthony? This is where I would be at, but I looked at the 5-point wide one would be the official paper trade if we have an official paper trade for Options Guy TV today around Meta. All right, let's remove this one, go back to this and hit that bid, and we're going to call it $2. Real good market. Market is 175 by 215. I do think you could fill this pretty close to $2. $2 of risk, $3 of upside, and you're going to know in a hurry. We only have 2 days to that expiration date. They're announcing after earnings today. All right, next, let's look at Amazon. Now, this is a little bit off the cuff here. I wasn't really planning on talking about Amazon, but we're not going to have a show tomorrow. Now, one of the things that I love about Amazon is Amazon always announces on a Thursday, and that means that you literally have a 0 DTE option, which is, you know, the big in vogue nowadays. So you have 1 day for these option contracts to live, and because of that, I like to look at butterflies. So I'm going to go the opposite direction and say, as an alternative to selling a short call spread, I'm going to sell that short call spread and let it pay for the butterfly. And that is called a skip strike butterfly. Now, a lot of people will call it broken wing, but I like to call it a skip strike because you're literally skipping a strike. And when you do that, you embed a short spread, which pays for that butterfly. So I always want to go farthest out of the money because you still have the risk of when you're doing a trade like this. So I want to go at around a 1 standard deviation move. Let's go back and do the math on once again on the expected move. So the expected move is always less than the 1 standard deviation move. Okay, so you got 1288 divided by 187. You're talking about a 7% move, 6.8%, and you're looking at about a $13 move. It's not an exact science. If we take 12, well, right, it's going to go right to 200. So that makes the math real simple. It's going to be right about 200. The delta on the 1 standard deviation move, which is highlighted very nicely inside the Tradier Pro options grid, we're on the call side of things, is 16 delta right here at the 202.50 and the 205. So we're right in between. This strike price is where we're looking to have where a 1 standard deviation move would be. Okay, so I am going to go out to this level and I am going to, it's going to be tough. I can't quite get it done for a net credit. Okay, let me look at it. Like I said, we're doing this one off the cuff here. I didn't look at it before we started. We're going to buy this one, sell 2 of these. Yeah, that's already a net debit. So we could only go 2.5 points wide with only 2 days remaining. I don't like it that much. Okay, so I'll finish the thought though. But this isn't a trade that I would do at this point in time. Oh, no, I did it wrong. There we go. No wonder. I'm like, how did that get to be a credit? That's not a credit because I got to buy that. So you're looking at a 17-cent net debit to the account. Yeah. And you're only going 5 points wide. A lot of times I can get a skip strike butterfly right around a 1 standard deviation move. I mean, the vol's at 100. Surprised I can't get this done for a 17-cent net credit, let alone a 17-cent net debit, actually. So let's just look at it at what a skip strike looks like inside the what if calculator. So here's what the scenario would be, but now I normally want it, the market's here. I would want the market to be at a net debit to the account. I would look to put on the trade tomorrow. I'd probably look at it again tomorrow. Probably could get something similar done for maybe a net credit if we get a little bit more of a pop. But you have 5 points of upside. That means you also have 5 points of downside. That's your maximum risk. This is the sweet spot if it lands somewhere in the middle. But if I do it for, let's flip the script and say it was a 17-cent net credit. Well, if the market goes down, I make money just like a short call spread. But if the market goes up, I'm okay as long as it doesn't blow the market away and go more than a 1 standard deviation move, which is also more than the expected move. So I don't mind this trade, but I would set it up tomorrow, and I would expect if I'm going to go 5 points wide that I'm going to get this done for even or hopefully a little bit of a net credit to the account. All right, that's what I get for going on a tangent. August 2nd, yeah. Not that exciting. All right, any other questions that we have? Now we are pressing up on time. So that's it for this edition of Options Guy TV. We're going to come back on Friday. Plethora of news between now and Friday to see how the market reacts. Is the Fed really going to hint at a rate cut in September? A lot of big stocks announcing earnings, and Friday will be an interesting Options Guy TV. Make sure to tune in 11 a.m. Eastern time inside the Tradier Hub, hub.tradier.com, on the Tradier YouTube channel, or streaming live on x.com. Thanks for stopping in, and we'll see you Friday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.